So hello everyone. Today we'll be pricing the vanilla options with cash dividend. So here's something that I want to tell you. Uh, Goldman Sachs and Morgan Stanley can look at the exact same Apple option and quote completely different prices. So it's not because of different views or risk appetite, but because they're using fundamentally different mathematical models. uh, we have been talking about 50-year-old unsolved problem in quant finance that after all billion mines, the Nobel prizes, the algorithm trading, Wall Street can't agree on how to price option when stock pays dividend. So today I'm implementing a search paper that exposes the massive blind spot. I will show you three different models, prove they give widely different results, and reveal which approach the market smartest. By the end, you will understand why your Apple option might be mispriced and how these small differences create real inefficiencies that sophisticated traders can identify and potentially profit from them. So I have already written a basic import statement that we'll be using, the NumPy, Matplotlib, and Pandas. And let's start by defining some real world example parameters. So let's just write here. So let's just take the S naught to be $180. So Apple like stock price we are taking, and K, let's take the strike price to 185, slightly out of the money call option, and let's take the time to expiry is equal to 0.25 and the risk-free rate to be 0.05. The typical tech stock volatility to be amount sigma, let's take around 0.3%, 0.3, 0.3, and the dividend, let's take around 0.0. Quarterly dividend gives 1.3% yield, so let's give it 0.60. So, and expect dividend in 1 month will be time is equal to 0.03. So let me paint a picture in front of you. Like Apple trade at $1, let's assume, and they announce a 60-cent quarterly dividend, and you own a 185 call expiry in 3 months. The simple question would be, what should you pay for the option today, knowing that the dividend is coming? Most people think that is basic finance, but it's not. There are several completely different mathematical approaches, and they can disagree 5 to 15% on the same option. Sometimes much more in extreme cases. So um, this is a core mathematical challenge. So this is what will replace the standard geometric bounding motion equation. So this is a standard GBM equation, and this breaks down with the dividend jumps at x dividend dates. So why? The reason is GBM assumes continuous smooth price movements, but dividend creates discrete jumps. This mathematical discontinuity means we cannot use the standard Black-Scholes framework directly. So now let's write the code for the class dividend problem. I will explain your three approaches. So just start by writing a function named class dividend problem, and let's just initialize self s naught k p r, the risk-free rate, sigma, dividend, and dividend time. Let's just initialize self dot s naught is equal to s naught, self dot k is equal to k, self dot t is equal to t, self dot r is equal to r, self dot sigma is equal to sigma, and self dot dividend is equal to dividend, self dot and time is equal to and now let's just let me define the function for Black-Scholes also for comparison purposes. So Black-Scholes Pn self, the parameters will be S, K, P, R and sigma, and if T is less than equal to 0, less than equal to 0, we will return the max of S minus K. We return the max of S minus K 0, and then we will let's define d1 is equal to np dot log S K plus R plus 0.5 into, we will multiply by sigma to the power 2 into T. We will divide it by sigma to np dot square root dot np square root np dot square root multiply by T here, sir, and define this. Now let me define T2, which will be equal to D1 minus sigma into np dot square root. Now we'll be returning, when we return, we'll return S into norm dot CDF D1 minus K into np dot exponential minus R into T into norm dot CDF D2. And now let me show you the actual problem is which I am talking about. So I have copied, which I have already written code, so that our both of us time don't get wasted. So was there? I'm so sorry. I committed here an error. There is here just square root. So we are ignoring the dividends. Now the fundamental question is, when Apple's stock price dropped by 60 cents on the expected dividend date, ex-dividend date, how do we model that mathematically? Do we treat it as a jump in stock price, or do we adjust the stock strike? Do we split the difference? So let me show a fundamental math that started this whole problem. So look at the equation 3. So here this is the universal forward formula that all models must satisfy. The forward price equals this proportional growth factor times the stock price minus the present value of all cash dividends. The FPT factor in equation 4 accounts for both risk neutral drift and proportional dividend jumps. This formula is actually beautiful. It's one of the things that all these models agree on. Each approach gives a different answer and is a crucial insight. Different trading firms use different models. This creates pricing inconsistencies that can lead to relative value opportunities and analytical advantages for anyone who understands these mathematical differences. So let me tell you how the spot model works. So I'm writing the code. The spot model, let me show you also. The spot model uses a place-wise geometric bounding motion. When the stock follows GBM between dividend dates, then jumps down discretely by dividend amount. So this seems intuitive model when what we actually observe. Smooth trading punctuated by dividend drops. It preserves the realistic stock behavior. How? So in between dividends, so is standard GBM. At dividend dates, a discrete jump. So it usually like watching a stock chart with normal volatility and then seeing a gap down over overnight when a dividend hits. So the model tries to capture exactly what see traders see. So now let's just for the first approach seem obvious. The stock follows normal random walks between a dividend dates, then jumps down by a dividend amount. We call this the spot model or the piecewise log normal model. So just let me show you how to code this. So let's just write class, find a class, spot model, and we define a function. Yes, initialize it. Self not k t r sigma dividend rent time. Self dot s naught is equal to s naught. Self dot k is equal to k, and self dot t is equal to t. Self dot r is equal to r. Self dot sigma is equal to sigma. And I just find self dot dividend is equal to dividend. Self dot print time is equal to dot time. Now let's just define a function for binomial American option. Binomial American. Let's name this and self to number of steps to be 100. And the American option, we're using the American option pricing with dividend jumps in the tree. So it will be like dt is equal to self dot t upon n steps, and u is equal to np dot exponential self dot sigma into np dot square root dt, where d will be equal to 1 upon u and p will be equal to np dot exponential, p will be equal to np dot exponential self dot r multiplied by dt minus of d, which will be divided by u minus d. Now let's just build the stock price tree. It will be like stock tree, let's define equal to np dot 0 n steps plus 1 n steps plus 1, and the option tree will be equal to np dot 0 n underscore steps plus 1 n steps plus 1. Now just let's initialize the final value. So for j in range of n steps plus 1, the stock tree will be n steps j is equal to self dot s naught into u to the power of 2 into j minus n steps, and the option 3 will be n underscore steps j is equal to max of stock tree n underscore steps j minus of self dot k c. So let's just work backwards to a tree. So we'll be writing for it for I in range n underscore steps minus 1 minus 1 minus 1 the current time, which will equal to I into dt, and for j in range equal to I plus 1, the stock tree will be equal to I j into self dot s naught into u to the power of 2 into j minus I. Now let's just apply the dividend drop if we are at a dividend rate. So dividend step net self dot dividend time divided by dt. If self dot dividend time is less than or equal to self dot t else minus 1, and if I is less than or equal to dividend dot step and dividend or underscore step is greater than equal to 0, the stock tree ij will be equal to max of stock tree ij minus self dot dividend 0.01. Now just calculate the options value. So it will be continuation equal to n p dot exponential minus self dot r into dt into p into option tree I plus 1 j plus 1 plus 1 minus P into option tree will be I plus 1 J. We will define exercise is equal to max stock tree I J minus self dot K 0 B option tree 0 option tree will be tree I J be equal to max of continuation exercise. And we will return option tree 0 0. Now let me just show you. So here we got the spot model result, that is $9.53. So a spot model has practical limitations, though when stock trade near dividend amounts, you need additional modeling assumptions about corporate dividend policy. More critically, the approach lacks the analytic solution. More importantly, there are no analytic formulas even for European options. You need numerical methods that's computationally extensive when you are pricing hundreds of thousands of options in real time. The second model will be the hybrid models. So the second approach is more elegant and it's brilliant insight. Instead of the modeling the full stock price, we split it into two parts. First, a pure business that follows geometric Brownian motion, then plus a separate piece representing the present value of future dividends. So here's a brilliant insight that changed everything. Equation 12. Instead of modeling the messy stock price directly, we split it into two clean bases, ST plus DT. ST is a pure stock that follows perfect geometric Brownian motion with no dividend jumps. DT is this shift function that captures all dividend economics. The decomposition is what makes hybrid models so elegant. We have separated the randomness from the dividends. So the mathematical framework is something like this. So this is the hybrid approach, decomposes stock price, ST, FT minus DT, XT plus DT. So basically ST is the observed stock price and FT is the forward price, and it is the present value of future dividends, the shift, and XT is the marginal with EXT is equal to 1, the pure stock. So this separation allows us the pure stock component to follow the standard geometric Brownian motion. So no jumps while dividend effects are handled through deterministic shifts. This preserves the mathematical tactability. This is a universal forward formula, which is Ft is equal to Fpt is equal into S naught minus. We will take summation from di Fp ti, where Fpt, the equation I have given, you can refer here. This is the proportional growth factor that account for the risk neutral drift μs and the proportional dividend jumps. Now here's where it gets interesting. Look at these three equations, 18, 19 and 20. The full hybrid model in HM2 uses all future dividends, even those after the option expires. The partial hybrid in HM1 only uses dividends before expiry. See how it goes to 0 at maturity in equation 20. But the escape model in HM3, that's the mathematical magic. It blends between the spot and the strike adjustment using TI over T weight factor. Near term dividends act like spot adjustments, far term like strike adjustments. The three models, the difference I'm going to tell you. The first is the full hybrid model, which is the HM2. The properties are it uses all future dividends, arbitrage-free with smooth volatility, and the pricing depends upon dividends after option maturity. And the second partial hybrid model HM1, only uses the dividend before option expiry, so no strike adjustment at maturity, and we can create a calendar arbitrage opportunities here. And the third one, the HM3 model, which will be the which blends spot adjustment, near-term dividends, and with strike adjustments, far-term dividends, and the weight factor, which will be the TI upon T, determines the blend ratio. So the beauty of this firm framework shows up in the equation 70. For European options, we just take the standard Black-Scholes formula and adjust both the forward and the strike by the same dividend shift D. That's it. One simple adjustment transform any dividend problem into clean no dividend problem. Compare this to a spot model where there is no closed form solution at all. And we have written the European option pricing formula here. The key advantage is the pure stock follows GBM, no dividend jumps in the tree here. So now just let's just code the hybrid model framework. So let's just define the class hybrid model def init self s naught k t r sigma dividend time and the model type. Well, now just set parameters self dot s naught is equal to s naught, self k is equal to k, self dot t is equal to t, self dot r is equal to r, self dot sigma is equal to sigma, self dot dividend is equal to dividend, self dot dividend time is equal to dividend time, and self dot model type is equal to model type. Now let's define the function of def calculate dividend shift self t a option. Now we'll calculate the dividend related adjustment dt. So if self dot dividend time is less than equal to t, we will return 0, and PV dividend parent value of dividend is equal to self dot dividend to np dot exponential minus self dot r into self dot dividend t I minus p, and if self dot model type is equal to full. Now the full hybrid model will be returned. Full hybrid always include dividend PV. So return PV dividend, and else if will be self dot model type equal to partial. The partial hybrid model only if dividend is before option expiry. So if self dot dividend time is less than equal to the underscore option, we return PV dividend, else we will return 0. So other else if self dot model type is equal to the SK model. So the SK is spot strike adjustment blend. So will be if self dot dividend time is less than equal to T option, the weight is equal to self dot dividend time, so time whereby T option, and we return PV dividend into 1 minus weight. The else will become else we return 0. And let's define now the other function that will be the binomial American hybrid. So it will be something like binomial American hybrid will be self and steps is equal to 100. And the American option pricing with hybrid approach, so will be right, dt is equal to self dot t upon n underscore steps. The u will be equal to np dot p by self dot sigma into n p dot square root dt. The d will be equal to 1 upon u, and p will be equal to np dot self dot r into dt minus d divided by u minus t. And we will calculate the initial shift, which will be d0 equal to self dot calculate dividend. Let's define it something like dividend shift, which will be 0 self dot t, and the pure stock 0, which will be equal to self dot s naught minus t naught. So now we're building pure stock tree, no dividend jumps. So it will be pure tree, have a space here. Tree is equal to np dot zeros n steps plus 1 n steps plus 1, and the option tree will be np dot zeros n step plus 1 n steps plus 1, and we will be initializing the final value. So it will become something like for j in range n underscore steps plus 1 pure tree and steps j is equal to pure stock into u to the power 2 into j minus n underscore steps, and at maturity we will calculate the final strike adjustment. So it will be dt, which will be equal to self dot calculate score dividend shift and self dot t and self t adjusted strike will be equal to self dot k minus d underscore t, and the option tree will be equal to n underscore steps j, which will equal to max pure tree n underscore steps j minus of adjusted strike 0. Now let's just work backwards. So let's write the code for it. So for I in range I plus 1, we define current time will be equal to I into dt, and for j in range I plus 1 pure tree I j will be equal to pure stock 0 into u to the power 2 into j there's an error, 2 into j minus of I okay. So now just calculate the time dependent strike adjustment, which will be dt is equal to self dot calculate dividend shift the current time self t, and the adjusted strike will be equal to self dot k minus t underscore t. So the options value, which will be equal to continuation, is equal to np dot exponential minus self dot r into dt, and the p into option tree be I plus 1 j plus 1 plus 1 minus p into option tree I plus 1 j. And I will define exercise, which will be equal to max of pure tree I j minus adjusted strike 0, and the option tree will be equal to tree I j will be equal to max of continuation exercise, which will return, so return the option tree. Now let's just test all the hybrid models. So let me just write all the print statements for our easy reference. So actually the error was here, so I define it like this. And another error is here, and here I put a dot instead of comma. So the hybrid model result is full hybrid model returns 9.23, and the partial hybrid returns 9.23, and the SK hybrid returns 9.32. So let's just explain the mathematical framework of volatility relationships. The volatility across different hybrid models are led by the analytical formula. This is a formula. So since where you can refer this equation. So since all the models represent the same underlying option, their implied volatility must be mathematically connected to their pure forward prices. So this is a pure forward price for the model. And this relationship comes from Black-Scholes formula applied to adjusted forward and strike for each model with pure forward ratio determining the volatility scaling. So I have written this all here. So the ordering property is this for same market prices. Reasoning is why? Because D3 is less than D1 less than equal to D2. So pure forward satisfies F3 greater than equal to F1 greater than equal to F2. Okay. So looking at this result, we're seeing 50 cent to $1 difference between the models. So that's not a rounding error on $1 million option position. There's a significant change if we are doing large number of positions. So we are talking about real money. So the three hybrid variants differ in how they handle dividend adjustment. Full hybrid uses all future dividends in the calculation. The partial hybrid only uses dividend before the option expires, and the SKM model blends between the spot and the strike adjustment. So each approach has different mathematical properties and practical implications. So the equation 25 blew my mind when I first saw it. It shows that the implied volatility between different hybrid models are related by this exact mathematical formula. Look at this. If you know the volatility in one model, you can calculate the volatility in any other model to within a fraction of basis point. This relationship even holds for American options with earlier exercise. Wall Street had been using different models when they are mathematically equivalent. So now let's stress test this model across different scenarios. I'm going to vary different amounts volatility and the time to expiration to see how the model behaves. So I have already in the codes, I will be using them. So that we don't waste our time. Let's just compare the model. So as you can see, in the base case, the spot model has 9.59 and these are the results for this. And the high dividend case, the 12.6%, the full hybrid model, and in long term. So the summary table is something like this. We can see. Now these differences are staggering in a high dividend scenario, and we are seeing 12.6% error. So in the high voltage case, spread gets even wider. So see this inequality in equation 21. It proves that the SK model always gives the lowest shift, then partial, then fully hybrid. The mathematical ordering explains why we see volatility patterns we do. Since the shifts are ordered, the pure forwards are ordered in reverse, which forces the volatility to be ordered too. It's all connected by this beautiful mathematical chain. This is the main part I'm talking about. This is happening in the real markets every day. When Tesla pays a dividend, when Apple adjusts its payout, when any dividend paying stock trade options, different firms are getting different value using different models. So let me just visualize the code. So it will be so as you can see this same option and different values. You can see this. So if Goldman says use spot model and Morgan says use spot model, the same option, different prices. So this become a risk-free opportunity. So this is the arbitrage opportunity. You can refer these graphs. So let's come to the solution part. So which model should you use? The search is clear. The hybrid models are mathematically superior to the spot model. They are faster, they are more accurate, and they avoid arbitrage issues. Between the hybrid variants, the SK model emerges as a winner and avoids the arbitrage issues. It gives smooth volatility services, minimum arbitrage opportunities, and pricing that almost identical to the theoretical pure full hybrid model. So the search paper shows something shocking in this arbitrage test. The partial hybrid model can have 30 cents of calendar arbitrage. That's massive. But look at the SK model. Virtually zero arbitrage even in extreme scenarios. The math here proves that SK preserves the no arbitrage properties while fixing the practical problems of the other models. So this is a binomial tree transformation. So instead of modeling ST directly, model pure stock as this, and these are standard binomial parameters. So key insight is apply to pure stock, no dividend terms. So tree algorithm is build tree for pure stock, adjust strike by time dependent shift, and use a standard American exercise algorithm. That is fast, accurate pricing with analytical European formulas. So these are the model valuation scorecard. So you can see the SK is fast and SK is arbitrage free, and it gives smooth volatility surfaces. And in the practical implementation, it also is the best. So the adoption is partial hybrid is common adoption. SK is the emerging part, and the spot is the academic literature, academic literature. So the SK spot structure model, fast and accurate like other hybrid models, and smooth volatility surface, no jumps, and minimum arbitrage issues, and the best practical compromise for real trading. The final example is Apple scenario. The spot model gives 9.534 and the SK model gives 9.325. And now here's the bottom line. So the Wall Street 50-year-old problem can be solved by the SK model, which gives the maximum accuracy. And if you're managing option portfolios or coding pricing libraries or interviewing for quantitative roles, understanding these differences gives you a real edge. Most people don't even know these problems exist. So in today's, we have uncovered that it isn't just about academic theory. It's a fundamental inefficiency in one of the world's most sophisticated markets, and different trading firms are literally using different mathematics for identical financial instruments. So the code I have shown you implements cutting edge such that most finance courses never cover. This is a kind of technical theft that separate quant analyst from everyone else. So the three key things to remember are: the dividend option price problem is real and unsolved in practice. The model choice creates measurable arbitrage opportunities, and the SK Hive model is best for practical solution. So the final code summary is: so solution, the SK Hive model is the best practical choice, and there was 10 to 20% difference, which is real money. So the code is available in description, and start implementing today. Thank you.